makers and market movers. This is The Pulse with Francine Lacqua.
Welcome to a special edition of The Pulse, live from the Berlin Global Dialogue, uniting leaders from business, politics, and academia on the biggest issues facing the global economy. Now, first, here are the top stories making the headlines today. Donald Trump ramps up pressure on Vladimir Putin to end the war in Ukraine, slapping sanctions on Russia's two biggest oil producers, oil soaring as a result. European gas also rising as the EU adopts its own fresh package of sanctions on Russia's energy infrastructure. The bloc joins a new U.S. push to chip away at Moscow's ability to wage its war against Kyiv. Plus, Tesla's third quarter profit drops as rising costs undercut a record quarter of vehicle sales. But Elon Musk still wants his $1 trillion pay package. Now, we're going to bring you some top guests from the Berlin Global Dialogue over the coming 2 days, including the Bank of America France Chief Executive Vanessa Holtz a little bit later on in the program. Now, first thing is first, you know the drill. We start the show, we look at markets. Now, European stocks seem to be hovering near this record peak. Again, there's a lot of earnings. We're in the middle of the earnings season. Third quarter earnings continuing to flow in. The stock 600 gaining about 0.1, 0.2%. Of course, the big story is what's happening with crude jumping to a 2-week high. This is after the U.S. President Donald Trump imposed sanctions on Russia's biggest producer. And then gold. We always look at gold. That's our golden rule on the Pulse because it gives us a good indication of maybe money flowing outside U.S. assets somewhere else, and gold 4,099. Again, if you look at Brent crude, look, it's up almost 4%, and then earnings definitely changing the way we look at some European indices. We have another packed agenda for you. On the earnings front, Tesla disappoints. Elon Musk, though, still wants his $1 trillion pay package. On the market news, look, gold again fluctuating after retreating from a record price surge. But first, let's begin with a U-turn from President Trump, with the U.S. stepping up pressure on Russia by targeting its biggest oil producers with sanctions.
We canceled the meeting with President Putin. It didn't feel right to me. It didn't feel like we were going to get to the place we have to get, so I canceled it. But we'll do it in the future.
Mr. President, can you tell us a little bit about why you're elevating sanctions against Russia right now?
I just felt it was time. We've waited a long time. I thought that we'd go long before the Middle East. And Mark, as you know, we did the Middle East plus 7. So we did 7 different wars.
Well, let's bring in Chad Thomas, Bloomberg's executive editor for Europe. Chad, thank you for joining us. It's great being here because we're going to have some great conversations with some of the newsmakers. But if you just followed what Donald Trump wanted to do with Russia and Ukraine, kind of got whiplash because it was a big week to try and understand whether he was friendly with Putin, wanted to meet him, and now these big sanctions.
We got huge whiplash. You and I were talking just a week ago, and we were talking about the Budapest summit. And did that make sense to do that? Should President Trump meet with President Putin for a second time, and whether he was being played? Clearly, within the last week, things reversed significantly. We were hearing already early this week that the talks between Rubio, the Secretary of State, and Lavrov, the Russian foreign minister, weren't going well. And then Trump not only backed away from the idea of there being a second meeting, saying it would be a waste of time to do that now, but he slapped these sanctions on Russia. This is what the European Union has been asking the U.S. to do for a long time. There will be a significant impact on Russia here. These two companies are 50% of oil production out of Russia. 25% of the Russian budget comes from these two companies. So if you want to impact Vladimir Putin's ability to wage war, you just did that.
Yeah, I mean, why did it take so long? I guess it's one of the questions. The other one is the ripple effects will be felt far and wide, including China. That buys still a lot of Russian oil.
Yeah, why did it take so long? People were really pushing President Trump to do something, and he's been saying for months that he would. He did say yesterday, and I think this was interesting, I've had some great talks with Vladimir Putin, but then nothing happens. He seems to have finally decided that he needed to take action. China today, we're seeing real strong reaction there. They get 20% of their oil from Russia, and so there's a real concern. they either have to abide by the sanctions or they face the consequences of secondary sanctions on them when it comes to things like access to SWIFT and so on, where Russia obviously has already been cut off from that years ago when the full-scale invasion of Ukraine took place.
So yesterday, a lot of leaders were in Europe, actually in the UK. Yeah. That's a Freudian slip. Still Europe. And today, actually, there's an EU leader summit. What can we expect from that?
Yeah, so we've already seen this morning more sanctions coming out of the European Union against Russia. It will clearly be a big topic. This, by the way, the European Union, Trump says that they love sanctions. This is the 19th sanctions package against Russia from the EU. It's really an effort by them to cut off the ways in which Russia has gone around some of their previous sanctions. So clearly that will be a big topic of discussion at the Leader Summit starting a little bit later today.
Chad, thank you so much. As always, Chad Thomas there and his team with some great coverage, of course, coming all over Europe. Bloomberg's executive editor for Europe. Now on to some corporates, and Tesla profit plunged as rising costs undercut a record quarter of vehicle sales. Now shares in pre-market actually lower, with analysts saying there's just not much to inspire investors and really questioning the timeline to develop new businesses like AI and robots. Well, despite the concerns, the chief executive, Elon Musk, ended the call by pleading with investors to ratify his upcoming $1 trillion pay package.
The point is, I just like that there needs to be enough voting control to give a strong influence, but not so much that I can't be fired if I go insane.
Let's go straight to Craig Trudell, Bloomberg's global autos editor in London. Our cards are. Craig, I mean, this is a pretty extraordinary end to a difficult earnings call.
It was, and I guess, I walked away from some of those comments, scratching my head, because if we really sort of have any doubt as to the amount of control that Musk has of this company, it's reinforced quarter after quarter that he's taken them in this direction of kind of sticking with, just the product that they have in terms of their actual core vehicle business. It's been years since we've seen this company bring out entirely new models. The Cybertruck was the last one added. It's also been quite a disappointment and was a product that Musk was very hands-on with. And yet, he is very much in control of this company. And this is a company that is taking his lead into these uncertain directions, chiefly I would sort of flag humanoid robots as being sort of the best example there, where it's really unclear just how quickly this, business is going to be something tangible for investors to wrap their minds around.
Craig, can Elon Musk turn Tesla's fortunes around? I feel like I ask you this every quarter.
Yeah, I mean, I think there's a big debate over, this idea that the auto business is getting really difficult for everybody, right? And it's getting particularly tough for electric vehicle makers where, and particularly for U.S. companies, right? In that with the $7,500 tax credits in the U.S. going away at the federal level, real concerns about how much of an effect that's going to have on the EV industry more broadly. And, a quarter ago, we heard Musk acknowledge that may lead to, in his words, a few rough quarters for Tesla, going forward. There was very little sort of discussion of that last night, which I found surprising. And it was much more emphasis on, again, the humanoid robots that Musk refers to as Optimus, and also on sort of robotaxi efforts that are still, not quite actually robotaxis. You still have human operators in these vehicles that are sort of there to step in and prevent against any crashes or accidents in Austin, Texas.
Craig, I'd love to get a humanoid robot on TV actually next time. It's you and I on the pulse with a humanoid robot. This morning, we also had some pretty strong numbers from Volvo Cars. Challenges ahead. That's what the chief executive told us this morning.
Yeah, I think Hakan Samuelsson, to his credit, was pretty clear-eyed about that, and yet the market absolutely is loving what he had to say this morning and the numbers he had to present. This was a company that, when he left it a few years back, was in quite good shape. I think the company sort of felt really compelled to bring bring him in as a steady hand to turn things around, because performance has gone in the wrong direction since he left. And he's only been back since April, I believe, and we've seen some pretty decisive moves on his part to really cut costs and sort of unwind some of the things that were happening under Jim Rowan, who was running Volvo for the years since he had stepped away. So, kind of walking back some of this ambition to go fully electric as quickly as previously thought. And again, just, sort of reining in costs. I think, the job cuts that Samuelson has announced and moves to sort of improve the operations of this business are bearing fruit much more quickly than everybody was anticipating going into this print.
Craig, thank you so much. What a story. Craig Trudell there, our Bloomberg Global Autos editor. Now, a majority of European Union members, including Germany and France, are now calling for a systematic review of bloc's regulations by the end of the year. It's hoped that the push will dismantle old rules that pose challenges for the competitiveness of EU companies, which are facing a host of headwinds, from tariffs to the ongoing war in Ukraine. Now, these themes are top of the agenda at this year's Berlin Global Dialogue. And I'm now delighted to be joined by Lars-Hendrik Röller, the founder and chair of the event. He also served as chief economic advisor to the German Chancellor Angela Merkel. So thank you so much for joining us. Thank you so much for having us. Actually, it's a great event that kind of brings public and private newsmakers at the table. First of all, when you look at Germany, I mean, we talk about an economic revival. This has not happened yet. When do you think we'll have meaningful growth in this country?
Well, I think we're in a very important time. I think this fall is going to be very important, as the German Chancellor said himself. There's a very important summit in Brussels also today and tomorrow, which looks at these regulatory issues. As many have said, Europe is too regulated, so I think that is important. The second element, which I think is very important, that Germany relaxes fiscal, so-called the debt brake, for more infrastructure, but also for defense spending. And now the proof of the pudding is in the eating, that you have all that money and all that flexibility, but now you need to do the reforms, you need to make it easier, you need to create space for private investment to come into place, all things we'll be discussing at the Berlin Global Dialogue, so that that money actually leads into growth.
How is Chancellor Merz doing?
He's doing fine. I think that he's certainly brought Germany back on the international stage. And I think that's very important. And I think a big priority for him is actually Europe, even though he's also, met with Donald Trump and with many other world leaders. But he has to do homeworks at home, and that includes Europe. And he needs support to do it. Germany is a complicated country, not the only one. France is also challenging right now. But I'm quite hopeful that he's going to be able to do it.
What do you think are the main obstacles, actually, for Germany, but also maybe for Europe? I mean, in Germany, is it geopolitics?
Right.
Is it trade?
Yeah, trade is important. I think the defense sector also as an engine of growth for Germany, transforming the economy. Because Germany is an industrial powerhouse. We have lots of companies at the Berlin Global Dialogue which would be willing to move into these areas related to defense or dual use. But it's not easy to transform your economy. So I think that's an issue. And the other one is sort of other regulatory constraints. For example, climate change. We haven't decided on our NDC goal for the Paris. Paris is 2 weeks away. And therefore, don't change the goals. I think we all want climate neutrality by 2050, but I think the way to get there has to be redone, and this is not easy.
But what is the right way? I mean, we're seeing a number of things also from Brussels actually being changed, some of the laws with deforestation maybe taking more time.
That's right.
I mean, there could be a link between defense rights and climate change. Is that far-fetched? Some people say it should be folded into the ESG world.
Yeah, I think defense is an important aspect of it. Yeah. I think what you mentioned is true, that we should not overdo it in terms of time. I think we should have realistic goals. And as I said, the reporting and the regulatory stuff, I mean, this is really horrible when you look at it. Yeah. They were all there for good intentions, so it's not the intentions, but actually we need to be more pragmatic and think about what generates growth, and that is a change of mind, which I think is happening in Europe.
But does that happen by actually breaking up the rule book? So if you say, look, we're going to really cut down on regulation, and again, let's see actually what happens on that. Right. At the country level, some people have tried. Right. Then do you really become competitive towards the US and China?
I think that's a big part of it. By the way, we had, I think, 3 regulatory packages under the Merkel regime. So as you said, we've tried so many years. The big difference between then and now is it's blatantly obvious that we need it right now, because I think Europe is going to be irrelevant in the rest of the world if it's not economically strong. That was different 10 years ago. We were doing actually much better economically relatively to other parts of the world. So the pressure is there. There are proposals on the table, which heads of states will discuss today and tomorrow. One big issue, which I think is very important, is rather than having what people call an ex-ante regulatory approach, that before you do anything, you need to report and you need to show there are no risks, to an ex-post approach, when you actually intervene, is more the American way of doing things. If things don't go well, you intervene afterwards, but you let people go and get started.
But what would you do? I mean, is it AI regulation? Again, we don't have these big AI companies, and the energy market is a bit of a mess in Europe.
There's AI, there's climate, there's supply chain management, all of these. I think the AI Act, we are trying to look at a European way of doing AI, which looks also at security and trust, and remains to be seen, and that people are skeptical whether this is really a market or whether we should be more innovation prone. But this is on the table, and also a discussion we're having here.
Christine Lagarde actually steps down from her role at the ECB in October 2027. Is it time for a German to be in charge of the ECB?
If you ask a German, I think it would be time, but it's complicated. It's usually also a package deal with other jobs, but at that time I think the other big jobs in Europe are not on the line.
Who would you put forward? You're so ingrained in German politics. You must have a list or a name.
I like our finance minister, ex-finance minister, your cookies. I think he's a good person, but there will be others. And I think it's more important to get a good person, but it also applies to other countries. In the US, there's also a big change coming up with, Kevin Hassett, who's a good friend of mine, is also in the running. But to get the right person to do that, and I think we'll do that. Yeah.
Thank you so much for joining us, Lars-Hendrik Röller. They're the founder and chair of the Berlin Global Dialogue, and of course we'll be broadcasting live today and tomorrow with many panels, so I know we'll see you around the corridors. Now, coming up, it's been a turbulent week for gold prices. We'll discuss all of that with Lombard Odier's Nannette Hechler-Fayd'herbe. That's next, and this is Bloomberg.
I think the Fed should be putting a little bit more weight on the fact that the stock market's been very strong, bond yields have fallen, the dollar has weakened, credit spreads are narrow, all those things are supporting economic activity, and put a little bit less weight on the level of the federal funds rate.
That was Bill Dudley, former New York Fed president and Bloomberg opinion columnist. Now, it's been a pretty dramatic week for gold prices. Gold fluctuating this morning. That's after a rout on investor concern over the market overheating. Well, joining us now is Nannette Hechler-Fayd'herbe, EMEA Chief Investment Officer at Lombard Odier. Nannette, so good to see you. Thank you so much for coming in, and in London. Nannette, there's three things that the market is obsessed with. Of course, it's credit because of the jitters that we had last week. It's gold, and it's AI. What does gold represent to you now?
Really, gold has been the one asset that has come forward in 2025 as the ultimate diversifier. Remember, in April, actually government bonds were not really helping to diversify. So gold has taken this new position for asset allocators. And it's also part of the explanation of the incredible rally and ascent of gold, in spite of the volatility now of past week, has experienced this year. So a very important asset for diversification purposes, but also for structural purposes, Francine. Gold is going to be really quite critical in everything that is happening at central bank reserve shifts.
So, Nannette, I mean, is this really also part of the geopolitical reordering? And if this is, maybe central banks selling treasuries, selling in dollar to buy gold, is there a target price, or does it just go up and up?
Well, you can take basically pre-Bretton Woods and take a look at how much gold represented in central bank reserves, and it's about twice as much as it does now. I'm not suggesting that central banks overall are going that way, but what is clear is that if the financial system continues to evolve and financial settlement systems continue to evolve with a parallel one where central banks are providing liquidity to each other in their domestic currencies, gold is playing a very interesting role as a security, if you like, against that. So I do think that central bank reserves are going to go up, and I do also think that this will push up the gold price. For now, our forecast for next year is that it might reach 4,600.
Nannette, if you look at AI, and we're in the middle of earnings season, there's a lot of concern that AI could be in a bubble, but then there's a good earnings report in an AI world, and then it keeps on going higher. I mean, it's priced to perfection.
It is, and at the same time, it's really quite close to what it has been all along. I mean, take a look at valuations. They are around 28. That is not far from what they have been on average as well. And it is very far from the absolutely excessive valuations we had during a true bubble, a true tech bubble in the dot-com period. Back then, we had multiples of around 55. Right now, we are turning at around 28. So you can see that we, I think, are not in this completely overextended terrain. But what I really would want to point out is that earnings growth as well, Francine, has been really strong in a lot of these AI-related companies. And they are turning around 1.5 or twice as strong as the market globally. So I do think that there are fundamental drivers that are explaining this strength and these prices. Of course, one has to be very selective. And within all these technology stocks, there are some smaller ones that have really seen a very strong multiple expansion and where earnings have not so much been supporting that. There you have to apply caution. That's very, very clear. But selectivity, in my view, doesn't mean that we are facing a bubble here. On the contrary, AI is at this moment really standing ahead of a very broad adoption.
Yeah. Is there a worry actually that there's too much money, that there's too much investment, for example, going in data centers? Because if you don't see a return in a fairly brief time horizon or timeline, then maybe there's just going to be overcapacity.
It's very true, Francine, that the capital expenditure into the infrastructure of AI and data centers are part of the infrastructure has been mind-boggling. But I do think that it is absolutely what will be required. I am confident that technology and AI is going to pervade so many different sectors and in particular services that the infrastructure required to process that is just going to be there. So I'm really not so worried about that trend. I think that the world of tomorrow is going to make use of data and, by the way, of energy in a way we haven't seen or imagined before.
Mm-hmm. Nannette, what do you do with the credit jitters? We were talking, last week whether there'd be more defaults, whether there's systemic risks out there. Like a chief investment officer at Lombard, Odier, like how do you deal with it?
I mean, look, we've been very, very attentive to all of these news. Anything that is happening on the credit market is always cause for attention for us, because there are really two areas that transmit into the global economy and into recessionary risks. One is credit, the other one is real estate. So anything that is touching to these two areas deserves a lot of caution. But the good news is, in our view, that these are at the moment very contained events. We have had some of them before. We are certainly of the view that credit spreads, Francine, have narrowed down to a point that they are not really compensating for any credit risk. And therefore, we have taken the decision to be a little bit less overweight, in fact, neutral now on investment grade credit, where we find that the overall yield is probably not going to give us much more room for bond price appreciation.
Mm-hmm. Nannette, thank you so much. Nannette Hechler-Fayd'herbe, their EMEA Chief Investment Officer at Lombard Odier. Coming up, we'll be discussing long-term capital markets with John Bilton, Global Multi-Asset Strategy Head at JPMorgan. Welcome back, everyone, to a special edition of The Pulse, live from the Berlin Global Dialogue, uniting leaders from business, politics, and academia on the biggest issues facing the global economy. But first, here are the top stories making the headlines. Donald Trump ramps up pressure on Vladimir Putin to end the war in Ukraine, slapping sanctions on Russia's two biggest oil producers, oil soaring as a result. European gas also rising as the EU adopts its own fresh packages of sanctions on Russia's energy infrastructure. The bloc joins a new U.S. push to chip away at Moscow's ability to wage its war against Kyiv. Plus, Tesla's third quarter profit drops as rising costs undercut a record quarter of vehicle sales, but Elon Musk still wants his $1 trillion pay package. So the European Union is adopting a new package of sanctions targeting Russia's energy infrastructure. The move includes a ban on LNG imports from 2027. Let's get straight from Bloomberg's Brussels bureau chief, Suzanne Lynch, who's monitoring events at the EU summit. Suzanne, thank you for joining us. So tell us more about these sanctions and what exactly is in the package.
Yeah, so this is the 19th sanctions package that the EU has brought forward against Russia. So it's been tightening the screws gradually since that full-scale invasion of Ukraine. In this package, we're seeing them targeting some more Russian entities, but also significantly Indian and Chinese entities that are seen to have facilitated the Russian war effort. It's also including that very important ban on LNG. That was a very important part of this package. Now, why this is significant is that over the last few weeks here in Brussels, diplomats had been negotiating the finer points of this, and we had objections from countries like Austria, which was concerned about implications for a bank linked to the oligarch Deripaska. We had concerns from Hungary and we had concerns from Slovakia. The situation now is that all those countries lifted their concerns, and that is why we have agreement here today at this EU summit. So it's a big win for Europe, and I think it's very important that the EU is able to show something, some deliverable, particularly as it welcomes Vladimir Zelensky, the Ukrainian president, here today.
And Suzanne, this, of course, all comes as Europe is looking to really strengthen its defense strategy.
Absolutely. I mean, I think there's been a lot of concern here over the last few weeks about the fact that Europe yet again seems to be watching from afar as the future of Ukraine is mapped out between Donald Trump and Vladimir Putin. But of course, we've seen a lot of flip-flopping by the US president on Ukraine policy. Earlier this week, leaders were scrambling to respond to the fact that they thought a summit was going to happen between Putin and Trump in Budapest, in Europe, on European soil. Now it seems that's not going to happen. And then we've seen this latest move by the United States last night, which we do believe the EU was aware of, about these new sanctions on Russia. So we see Donald Trump tightening the screws and getting tougher on Russia. So I think the EU all the time is trying to prove that it's a serious defence player. It has enhanced its own defence capabilities, and it's doing things like the sanctions package and also a move to use these immobilised Russian assets, most of which are based here in Belgium. Now, we do expect EU leaders to discuss this today at the summit, which is just beginning around now, but we don't expect a major sign-off on that. Rather, we expect leaders to give the European Commission the mandate to come back with a proposal. This is highly complex. The idea of using these assets to help Ukraine is extremely complex. Belgium wants other countries to share the risk. The Belgian Prime Minister here today, coming into this meeting, was very clear that he's got demands before Belgium will agree to this. So there's a lot of road still to go on that issue, but we do expect some progress here on that today.
And Suzanne, Europe is also facing this harsh reality check to cut its emissions. Are leaders likely to actually reach an agreement on that?
Yeah, that's something that we expect could really, open up a Pandora's box here in Brussels today. Climate targets are on the agenda. And again, as always with the EU, you see some very different perspectives. Different countries, trying to protect their own industries, if you like, and their own energy mixes. So on the agenda is discussion about the 2040 climate targets by the EU. But really what we've been seeing, Francine, is a real pushback against some of these strict targets. We've been seeing a lot of debate, a lot of pushback from business, from corporations, from capital saying, look, we need to be careful not to stifle innovation, even though the EU has generally been a leader on climate. So some pushback from some of the bigger countries here. This is all coming, of course, ahead of the COP climate talks that are going to happen very soon in Brazil. So we don't expect any decision on this. We do expect a very tense debate. And then in early November, EU environment ministers are going to come together. And that's when we should see more decisions on targets or a range of targets that the EU will hit.
Susan, thank you so much. Suzanne Lynch there, Brussels Bureau Chief. And then I'm looking forward also to catching up with Susan, who's on her way tomorrow to the Berlin Global Dialogue. Now, Thales's third quarter orders and sales beat expectations thanks to strong defense demand. That's as governments across the world, of course, seek to bolster their military capabilities. It comes as Thales and aerospace peers Airbus and Leonardo seal a deal to merge their space businesses in an effort to compete with Elon Musk's SpaceX. And Europe's most valuable software company, SAP, has offered a mixed forecast for 2025, which has sent shares lower. Well, SAP sees full-year revenue for its key cloud business trending towards the lower end of guidance. Investors have been focusing on SAP's progress with cloud sales since the chief executive, Christian Klein, pivoted the company away from selling traditional software licenses to subscription services. Well, SAP's chief financial officer says the company has maintained momentum despite an uncertain macroeconomic backdrop. And the blurring between public and private markets and the future of the AI boom are just some of the top themes in JPMorgan's reports on long-term capital market assumptions. Now, for more on this, we're joined by John Bilton, Head of Global Multi-Asset Strategy at JPMorgan Asset Management. John, great to speak to you. It's like a yearly catch-up on this report. Is it much more difficult now looking at long-term trends, given all the volatility and all the disruptions we're seeing almost on a weekly basis?
Yeah, so it's actually always interesting to actually take a step back. And I think any investor who's caught up with the news flow, what's the Fed up to, what's the ECB up to, and quarterly earnings, to actually take that step back. So it's especially important at a time like this. And this is our 30th edition. We use it to run $1 trillion of the assets that we're privileged to look after. So it's incumbent on us to do that. And actually, we have had this really interesting year of a lot of changes. And we titled the report Shifting Landscapes and Silver Linings because there's so much going on, which is changing the economic fabric of how we think about the world. Things like trade friction, restrictions on labour, which are bringing down how much workforce we have to drive global growth. But surprisingly, we've had big fiscal responses, and we're beginning to see an uplift in total factor productivity as a result of capital spending, which is keeping growth moving at a reasonable level at a global, from a global perspective, but is starting to even up the differential between some regions, such as the US and Eurozone.
John, and I love the fact that you've basically identified three key themes, which, frankly, we try and keep on top of, on the pulse on a daily basis. This is like AI and the impact on financial markets. It's, of course, privatization or private markets and the impact on getting the markets to more people, democratization, and then you have the emergence of new assets and market actors, which kind of backs up that. I mean, what will be most disruptive? What's a real game changer out of these three diverse forces?
Well, I think all of them actually link together in quite an interesting way. So if we think about, regulations and policy, we think we're moving away from a world which was principally driven by things like the inventory cycle, dictating the business cycle, to one which is much more to do with lurching between more extreme positions in terms of economic policy. We've seen a bit of that this year. So what's happening is that is prompting, to some degree, investment in productivity enhancing technology. And that's really where that whole technology angle comes into play. And the reason for that is, of course, that some of the issues around migration have obviously been in the headlines a great deal this year. Trade has, no doubt had frictions placed into its flow. And so as a result, we're having to see a bit of investment, a bit of capital spending to make up for some of that shortfall in the labour market. And what that's doing, of course, is that's giving a boost to the profit share of the economy. It's supportive for cyclical growth. It's supportive for companies. So even though we're seeing these frictions, actually companies are doing relatively well out of it. And what that's doing in terms of the overlap between public and private markets, of course, is we're seeing the private markets significantly leaning into this trend and really beginning to invest heavily in the next generation of this technology as it evolves. 36% of private equity is involved within AI, 25% of private credit, and 71% of deals in the VC industry this year have been involved in technology. And when you have this kind of investment, that kind of capital in motion, then it can be very supportive for returns over the intermediate and longer term.
John, I mean, on the shorter term, do you worry about private credit? We saw there were a lot of questions on when the next default would be after the week that was. So if you just put your news of the day hat on, how should we be looking at it now?
Well, it has a role in a portfolio. It's no doubt about it. But as with any credit instrument, there are tail risks to it. And when you get a big explosion, as we've seen in terms of the volume of funds going into private credit, then there is a risk that you get some issues at the margin with certain deals. Now, whether that's systemic, we're perhaps we're taking less of a sort of pessimistic view on that, because we do note that there's less involvement from some of the levered institutions. It's not bank balance sheets supporting this. Oftentimes it's real money. So, yes, there has to be proper sizing of the private credit risk within portfolios. But this is not something that is an industry that's going away. In our view, it's an extension of credit that actually means that you've got a buffer to some degree to the public credit markets. It's opening up credit availability to firms around the globe. And so it is a reasonable part of the financial markets. But this year in our numbers, the return expectations from private credit for the next 10 to 15 years have necessarily come down because there's been such a rush of money into there. So we're already reflecting that to some degree in the numbers that we expect. And certainly, in terms of some of the more recent news, as with any credit investment, you've got to be very, very aware of the left tail.
John, I like the report, and there's something that actually struck with me, right? It's a great read. It's an easy read. There's something about an inflection point, and you basically say that we're moving from cheap money or cheap capital to expensive capital. What does that mean?
Well, so if we think about the last 10 to 15 years, we've had predominantly a period where central banks were supporting growth with very easy monetary policy. It was coined the new normal back in the day. And of course, what we've now seen post-pandemic is much greater willingness of governments to use their fiscal levers. Now, this is going to be quite interesting in terms of how it works out. A country like Germany, of course, has plenty of fiscal headroom, and it makes sense to do a lot of fiscal spending. With other countries, you're perhaps taking more of a risk with the deficits. What that ultimately means is the gamble being taken is, can we use this deficit spending alongside the private sector to build productive assets so that we push up our trend growth over the long term? And some will do that right and some will do it wrong. And the issue, of course, that we have is that the cost of money has to rise to take on board the risk that some of this fiscal spending won't be well directed. So as a result, the overall cost of money goes up when we have that fiscal lever being pulled. So we've moved from a world where central banks really were the only ones providing the support for the economy, where we're now using the twin levers of fiscal and monetary. So monetary policy has to do less. Interest rates are necessarily that little bit higher. As a result, that cost of capital has gone up some.
John, what is the one thing that is actually the most underestimated by the markets, where you could see a correction because of what you found in your report?
The risk of correction, you're asking. I think, well, there's two things that are underestimated, and let's look at a negative and let's look at a positive, if we can. I think first and foremost, we've seen a huge rush into sort of some of these commodity type assets, particularly gold, and we're beginning to see that unfold in front of our eyes. There's been a bit of a correction coming through there. We do think that gold looks good over the long run, but investors need to remember that in volatility terms, gold is a lot more like an equity type asset. It has a volatility of around 13% compared with the S&P at around 16%, than it's like a bond asset, which has a volatility around 5%. And so we think that that's one area just to keep an eye on, because there's been a lot of rush into there. We still see a good outlook for gold, don't get me wrong. But staying with gold and thinking about currencies, that's where I think there's some upside opportunities. We've seen the euro appreciate 13% this year relative to the dollar. We've seen it appreciate about 8% relative to the yen. If we look at where a euro-based investor can look now, there's much less of a currency headwind from investing in the US, and there's still a currency tailwind from investing in places like emerging markets. So as a result, even though we've seen our outlook for European equities come down just a touch, about 10 basis points to around 7.2% average annualized expected return, the US number has come up and the emerging market number has come up, and that's about currencies. So for a euro-based investor thinking about currency overlay and just how to use that in a diversified portfolio, Europe's really in a sweet spot because of the currency moves.
John, thank you so much. As always, John Bilton, their head of global multi-asset strategy at JPMorgan Asset Management. Now, coming up, we discuss capital markets and the deal-making outlook for Europe with Vanessa Holtz, the Bank of America chief executive for France. This is Bloomberg. Well, Lloyds Banking Group raises its outlook for net interest income to £13.6 billion this year. That's despite earnings for the third quarter falling. Now, for more on this, we're joined by Tom Metcalf, who leads our EMEA finance coverage. So, Tom, thank you for joining us. What are your key takeaways from these results?
Well, like you say, a little bit messy because they're absorbing this big motor finance provision. So they've already disclosed an 800 million hit. So you're seeing that roll through these Q3 results. And it just distorts a bit of everything, so their profit missed, etc. But if you can back that out, I think broadly speaking, this is kind of as the market expected. So net interest income, that's probably the most interesting thing on the underlying business. They tweaked their guidance a bit, put it up very marginally. That's always a good sign. So yeah, perhaps no surprise to see the shares kind of unchanged really today, just because they've done a good job of flagging that motor finance provision, which otherwise would have come as a big nasty shock.
Tom, so how big could actually this impact be from the motor finance provision?
So far they've basically provided about £2 billion worth. And, it's still pretty much up in the air. Basically, where they are in that situation is with the UK regulator. They're basically having some back and forth and effectively telling the UK regulator, we think you're casting the net too wide. We shouldn't be on the hook for all these cases that you're sort of throwing our way. And that's true of all the banks that are kind of being dragged into this situation. So over the next few weeks, there might be some movement on that. I mean, it would certainly be a big victory for the banks if they're able to persuade the FCA to sort of roll back a little bit, and maybe you'll see that provision, that £2 billion provision kind of be reduced a bit or written off a bit, which would be obviously a bit of a win. I think right now what management are saying is this is a worst case scenario. We may be looking down the barrel of a £2 billion hit, and hopefully we can kind of even that out a bit, soften it a bit.
Tom, what are you looking for with results from NatWest tomorrow?
Yeah, they should be a little bit more straightforward than Lloyds. NatWest not as exposed to the motor finance thing, so we're not really expecting kind of too many external shocks or anything like that. I think, like with Lloyds, the biggest thing is what are the indications we can get about the UK economy. It was all fairly benign today with Lloyds. You'd expect NatWest to say something similar. I mean, every quarter these banks are basically saying the same thing is, yes, there's lots of macro doom and gloom, but when we look at our own books, when we look at the stresses our customers are under, we're not really seeing that flow through any results.
And Tom, finally, Jane Fraser at Citi has just been given a lot more power.
Yeah, exactly. She's CEO there, but also in the great American tradition, also now becoming the chairman. So, in the UK here, those roles are typically split, but in the US, it's normally an indication, you're really getting your back into the bank, right? So, real fillip for her. I think it's kind of also getting a bit more of a pay rise as well. And it just kind of goes to show it's very much her bank, right? Much as Jamie Dimon, JPMorgan. When you think of Citigroup, it really is Jane Fraser calling the shots there.
Tom, thank you so much. As always, Tom Metcalf there with all of our banking earnings. Now, it's been a volatile period for broader sentiment over the past week. European stocks headed for a fresh record as third quarter earnings continue to flow in. So let's discuss the capital markets outlook and how the deal-making environment is shaping up with Vanessa Holtz, Chief Executive of France at Bank of America. Vanessa, thank you so much for joining us. When you look at the capital markets in general, I don't know what you're seeing. We're still expecting a banking union. Is Europe more competitive? Are we going to see more IPOs in the pipeline?
So we've seen, resurgence of IPOs. It's been subdued for quite some time now, but, this year we've seen the number of IPO doubling in terms of volume, especially since Q3, during the summer. So it's definitely like some more interest from investor to do public offering. The question is, and the thing which is at stake is obviously we are in a more stable environment, with low interest rate, more certainty on the easing, geopolitical tension and uncertainty is still there, but it looks like the market is taking more confidence about the market itself. And I think overall, inflation is much lower. So I think it's all positive for the market to start to, reflect on renewal IPOs across the board. So
what are your clients saying? Are they, because there's still a lot of disruption, are they getting used to the slight volatility or kind of like news changing quite
I guess the
fast?
market is starting to get used to the volatility. If you look at the market trend, there's been a lot of obviously uncertainties. Financial assets have been moving all over, but the level of volatility itself has come down significantly. Obviously, even more since Liberation Day. So I think the market, and when the tariff gets to a kind of a stable stance, I think there's definitely some room for markets who have been delayed investment, delayed IPOs, to pull the trigger and make sure that it is happening right now. So we've seen definitely some increased volume on that front.
Are you expecting a catalyst actually for for like the animal spirits? I know there's a lot of things being discussed at the European Union level. Do we need something like regulation taking a back step for clients to be fully in?
Well, we definitely need this capital market union. We've been talking about it for quite some time. There is some progress that has been made, but there's still a lot of fragmentation. I think it's absolutely critical that Europe act with a sense of urgency right now. So everyone is mobilized. And I think securitization is a very key aspect of that. We need to de-risk, we need to have better source of financing. And I think deregulation and simplification is critical for the time being.
But Europe is looking at France and saying, look, this is what maybe Italy was like 10, 15 years ago. There was a credit downgrade. There's a lot of uncertainty politically. How's that playing out for your business?
Well, we still have credit downgrade in France, by Fitch and S&Ps, and obviously the service of the debt is increasing. So that's definitely on the radar. The deficit obviously is important. The budget, still needs to be passed at some stage. So yes, there is some turbulence, political instability, but I think, on the long run, France is quite resilient. We have a lot of strengths, France has been the one that attracted foreign direct investment in one of the first countries in Europe to attract that. There's still, the world-class corporate that is there. Financial ecosystem is still there. So I definitely think that there is resilience in France. The household saving in financial assets is huge in France. Yeah. So there's capital to mobilize, but it needs to go in the real economy. So that's the key aspect of this capital market union and securitization that needs to happen now. It's all the 27 countries that needs to go together. And as I was saying at the beginning, it is urgent.
Do people understand it's urgent? I mean, in your conversations with policymakers, do you think this is, a crucial point actually in a change in how Europe can reinvigorate itself?
I think people understand it's urgent. What is critical now is that Europe comes together, and obviously as the national, there is political agenda on each country. People need to overrate the importance of Europe beyond, obviously, the political national agenda, and I think this is critical right now. So there's definitely some work. It's slow, but I think the private sector and the governments need to act together to make sure this is happening.
I mean, Chancellor Merz was talking about some kind of pan-European stock exchange. Does that make sense?
Yeah, I think it could make sense, to have a pan-European stock exchange. I think it will help, all the transaction and flow the liquidity back into the European market.
Vanessa, thank you so much, as always, for joining us. Vanessa Holtz there, the Bank of America France Chief Executive. Now, plenty more to come from the Berlin Global Dialogue over the next 2 days. We'll have interviews including Ukraine's Deputy Minister for Digital Transformation. We'll be speaking to Bernie Mensa, Bank of America International President. And, of course, we'll follow a lot of the big conversation. We're actually speaking to Henry Kravitz and also Nadia Calvino a little bit later on. The focus still on earnings across the board. We're also getting a little bit of data. Not the easiest thing to understand what the Fed does next because of the government shutdown. But look, the main story is also oil. Oil is really up because of what we heard from President Trump over the U.S. So oil rallying after the U.S. announced these extra sanctions on Russia's two biggest producers. President Donald Trump ramping up pressure on his counterpart Vladimir Putin to negotiate an end to the war in Ukraine. Up next, it's Bloomberg Brief, and this is Bloomberg.